Welcome everybody. The noonday gun has just gone off here in our Cape Town studio where we're based, which signals the start of our weekly webinar. And for those of you that don't know me, my name is Neil Peterson. I'm the founder and content-in-chief of Real Estate Investor, South Africa's leading independent real estate content and education platform for more than 16 years. And today's investment webinar is hosted in conjunction with Opportunity Private Capital, your trusted partner with a proven track record of success. Now, we have Opportunity guest specialist, CEO and co-founder Nick Morgan, and director and other co-founder Wynand Haywood, which I will introduce them to you very shortly. And today's topic is how to achieve above average returns and unstoppable growth by investing capital in a struggling economy. So before moving on to our discussion today, here's a quick intro video that we'd just like to share with you.
Opportunity Private Capital is a 16-year-old boutique investment company that offers secure investment opportunities for private investors to earn attractive returns on their capital by investing in residential developments. Over the past 8 years, the focus has been on developments located in high-demand areas in Cape Town. The biggest benefit of this offering is that investors have early access to the development lifecycle. Instead of investing right at the end, as with the purchase of the final product, they invest during the actual development phase, where most of the value can be extracted.
Quite simply, there are two important aspects of these investments: security and returns. Development assets are held as security for investor capital until such time as they repaid. And over the last 5 years, investors have achieved returns averaging 16.75% per year.
Projected returns and predetermined investment periods give investors a good idea of how the investment will perform.
Great. So getting on to our topic for today, how to achieve above average returns by investing capital in a struggling economy. We will learn and hear. So how Nick and Wynand particularly adapted to market dynamics and investor behavior to build a thriving boutique investment business, and the winning model of Opportunity Private Capital, and the secret success formula that has led to an investor retention rate of over 80%. Focusing on the high demand areas. And we're going to also see some of the overview of current projects and the mission to make capital investments accessible to a wider range of investors. So opportunities for you. Opportunity, it's in the name. So I'd like to welcome our guest panelists, Nick Morgan and Wynand Haywood. They are the founders of Opportunity Private Capital. Great having you both again, guys.
Hi, Neil.
Hi,
Thank
Neil.
you.
Yeah, Neil, good to see you again, man.
Absolutely. So, yeah, I think it's, our discussions have always been very interesting as we've had all these different type webinars. So I want to kick in straight into that, Nick. And, we've seen over the last 3 years since the onset of COVID, there's been some really tough economic times all around. And, we got today now a little bit later, we're probably going to be an interest rate increase. There's high inflation, but you guys have been offering these investments for many years before that. So did this period put you under pressure to rethink this offering?
Neil, so interestingly enough, before the onset of COVID, when we heard about the lockdowns, etc., I think all of us were a little bit nervous about what was going to happen. And with us, it just turned out to be really fortunate, actually, because it proved the robustness of our offering. Because what happened during these tough economic climates is that investors have continued to receive their projected returns. Their security has never been in any danger, so the protection of capital has been in place. So really, I think it's proven to us and everyone out there that during the tough times is when we actually excel, ironically. So the last few years has been a really good litmus test for, I suppose, the structure of this offering that we put forward, because the 5 or 6 years prior to that, the market was okay. So we didn't see any fundamental challenges to this investment offering that we've got. And certainly the last 3 years has shown us that, in fact, it does stand the test of time and test of tough times as well. And to give you just an indication of figures, I mean, our capital investments are up by just over 170%. The capital, the units, should I say, that are funded in various projects, that's up by nearly 190%. And new investor participation is just over 155%. So the last 3 years has treated us, thankfully, really well.
Well, Nick, there must be something that you're doing right, because I think, it's not easy to find those kind of investments in these kind of times, and investors really have to trawl through many investments to find this kind of offering. But Nick, give us an update, on the status of the current investment projects. I know we saw the video, we saw briefly, but I think give us some more detail. Give the audience, just a little bit of, where are you right now? Because I know it's always there's always something happening, a new development, new investment, etc. So give us the updates.
Okay, so the interesting thing, Neil, is that the great thing about these investments, I think, and I think Wynand feels the same way, is it's very tangible. It's quantifiable. So as an investor, you're actually part of something that you see progressing. Often with traditional investments, you actually don't see your money working for you, whereas in our investments, one does. So, I mean, if you take the Indolini project, for example, which is coming to an end, that was 61 million in private investor capital was required for this project. It's gone really well. It's coming now towards its end where the units are completed, and you'll see as these images show chronological progression. So investors came in at the different phases as the building progressed. A few of the units have to be finished off inside, but it's virtually done. And around 80% of investors have already exited this project and rolled into other offerings that we have. Then also during this period, a project called Heron Fields was started. That to date is also coming to an end, and that required 49 or just over 49 million in private investor capital, all told, during the course of the project. And close to, well, I think it's just under 95, but let's say just over 90% of those investors have exited as well. And this project is also coming to its completion. And very excitingly, the current offering we've got is a project called Heron View, which is, funnily enough, adjacent to Heron Fields. And that's a complex of 166 units. That's now out of the ground with the first couple of blocks under construction. Beautiful site, I must say. Gee whiz, it's on the crest of a hill overlooking the mountains in the background over the northern suburbs of Cape Town. And we're actually ahead of our investment targets on this, which is very nice to see that the appetite for investors is very strong on this particular offering.
Excellent, thanks. I think a picture tells 1,000 words. So I think it's great to be able to see exactly what you're doing. And, a lot of investors are saying, well, look, what is it that I'm investing in? And the beautiful thing about bricks and mortar is that you can see it, you can touch it, you can feel it. And so I think that's fantastic what you're doing there. Wynand, I think we've got to look at the other side of the picture over here. What happens if this project fails or it just can't be completed?
Yes, look, as Nick just told us, he told us all the good news. So I will get to the side where, as you asked the question, is what happens when it goes wrong, and you actually used the word there, bricks and mortar. So the structure that we've developed over the last, let's call it 16 years, what it does is it allows the investors those actual bricks and mortar as security. So I mean, to get back to your question, what happens is, I think the best example would be is COVID, when everything goes belly up, where you find yourself in a scenario where you can't build, you can't sell. So what is it that from an investor's point of view, what is your position at that stage from a security point of view and from your investment point of view. So to take you through that process quickly, in our structure, what happens in a scenario like that, and on the assumption that the project is now stopped, is that the investor should always remember that the underlying asset is which he's got access to as for his security. So getting back to the bricks and mortar, it's a tangible thing and it's secure. So we've developed the structure whereby there's a security trust involved, and the trust holds the mortgage and the asset as security for the investors. So if we were to entertain that scenario of COVID and the project we were involved with, nothing could have been done with that project without the consent and the buy-in from the investors on the terms and agreements that we entered into. So an investor would typically enter into a 2-year agreement. So in that scenario, the investors were in for around about a year. So there was another year left in the project. So the project was delayed, but everything in that project worked out well with the investors being secured, that all the investors exited. So the only downside to that specific scenario was that the developer obviously had to take a bit of a lower return on the project, hence the delays. But when you look at the actual structure that we developed, is the trust who acts on behalf of the investors, okay, can always enter into negotiations with the developer after, let's call it the contract period of 2 years, and engage. And let's entertain an even worse case scenario that the 2 years has passed. What happens now? And this is where this structure offers a lot of security for investors. What typically happens in these scenarios in the normal development environment is that there'll probably just be 2 stakeholders, the financier and the developer. In this case, well, in the case that I just mentioned, typically in the environment, the financier will act in its best interest, which is correct. What we've developed here is when you find yourself in a scenario like that, the trust in consultation with the investors and the developer can get together and find the best resolve for the project. So if you were to role play it, we typically, when we do a project, we're busy with 12 blocks now, is we have enough funds, let's say, to build the half of that project upfront, just continue. So let's role play your worst case scenario, what happens? So if we go into let's call it a market meltdown tomorrow, okay, we can continue our construction for the next 6 to 8 months and finish all those construction. Should the market not have recovered by then, we find ourselves then in a scenario where we've got the assets, which technically the investors have got a right to. And then if you're in a worst case scenario, you've got the options to either say, look, we can sell it at a reduced price, or we can say we can rent out these units, and then the investors would in return for that, will earn an income on that. So what happens when things go south, the proverbial saying is, we've put these structures into place to protect and get the contracts right, to protect the investor and give him insights and inputs as to what's the best way moving forward with protecting the asset. And we've looked around, we haven't found anything similar to that, because investors, I don't think, always go to the full extent of doing an in-depth due diligence on when they do an investment. And hence we've created this model, and we're now entertaining a worst case scenario. Fortunately, we've been in a typical scenario, but we've negated through it, as Nick rightfully mentioned earlier. And there's obviously a lot of other aspects that you have to keep in mind, and Nick touched on it. When we look at engaging on a project, we look at good areas, good returns, good yields. So we also do all that sort of upfront work to make sure that when those scenarios present themselves, you've got the best possible exit and protection for your investors. Does that give you an idea?
Well, it's such a critical point, because any investment has some kind of risk.
Yes.
I think what you've done is you've covered all the bases. You've learned from the past, and that's where a lot of investors should look at. And in terms of specifically ensuring that the investor is protected. So I think it comes across very well, and I think it is something that is not normally as an investment option. People don't like talking about the downside. They like to just skirt through it quite quickly. But Wynand,
Yes.
let's go a little bit deeper here. Why are the projects 100% investor funded? Surely it would be more lucrative for the development company if the projects were geared to some extent, to say a hybrid of institutional investment and private investment.
Yes. Neil, that's obviously the obvious question from a high yielding. If the developer wants a high yield, then that's the best route to go. What we've seen over the last years, hence developing this model, is that should you get into a worst case scenario, and you look at your investor pool, the individual private investors, they'll be at risk if you have an institution involved as well. Typically, they'll play second fiddle. So there's no sort of guarantee that there'll be anything left on the table if the project were to go into some sort of liquidation or any of that those sort of aspects. So hence we moved away from that to purely fund it through private investors. That allows obviously for flexibility, and flexibility is a discussion, entirely a separate discussion, because it just sort of turns the industry on its head. You can start projects earlier, you can exit projects earlier, and the scenario that we just discussed now with risk, then in that flexibility, you bring the investors also to the forefront when you get into a worst case scenario. So it is more expensive, hence you need to choose your projects correctly to allow for that, let's call it higher interest from the investors.
Excellent. Okay, so to our audience there, I mean, there's a Q&A box, as I mentioned a little bit earlier. Fire your questions away. Try and catch these guys offside, man. I'm trying my best. With any investor over here, you kind of have to look at both the returns and also the risk side over here. And I mean, the track record speaks for itself. So Wynand, just give us a little bit of a recap for those that aren't actually familiar with your offering. Because sometimes, we look at it and we question and say, where can I find the holes in it? So what are the main benefits hereof?
But as I just touched on the security, I think that's probably, from my personal point of view, is one of the main benefits, is the security structure that we've put in place. I think people would probably, that whole myopic discussion would probably have a lower return and have more security with regards to their investment. So that's from a security point of view. Then the returns, as Nick outlined, are very attractive returns that we've been able to offer the investors over the last 5 years. So if you combine the two, you have a let's call it a higher than average return, and you have a unique security structure in place in this investment to afford a more secure and safe investment. So those are the two main legs. And then if you want to delve into more detail, it's a 2-year investment. So it's not a long-term investment where you lock yourself in for 5 years. And it also depends. The period might also depends on the pace of the project. So it allows the investor, and we've developed that system now. It allows the investor to plot his investments, as some of our investors are invested in various projects. They can plot their investment, and as you mentioned, the 80% retention, and roll it from one project to other. So again, it gets back to that personal investor flexibility. So I think you've got most of the bases covered there.
Excellent. Great. Nicely put there, Wynand. Once again, questions, please put them into the Q&A box below. we're ready to answer your questions, guys. So please fire away. There's a lot of you on this webinar. So, I'm sure if you had a question, what would that question be? And I think this is the opportunity. If you're not quite sure, there's no such thing as a stupid question either. So please fire away. Let's hear what your feedback is, your thoughts are, etc. Okay, Nick. So moving on to yourself. Now, there's a lot of investors, who want to get into the property investment space, but they find 100,000 Rand, which is your minimum sort of investment amount. It's a little bit of a stretch sometimes. And of course, there are those that also look for a monthly income, sort of a recurring monthly income. Now, it sounds that you have some news on that one. Do you want to tell us a little bit about that?
Let me just unmute myself before I start talking. Yeah, so interestingly enough, over the years, and we're going back quite some time now, we've had a lot of investors ask about whether we have an offering that produces a monthly income. And of course, we haven't, because the offering that we have is a capital investment that has to run the length of the life cycle of the investment, and the investor would get the capital in return at the back end once that cycle is over, which is good, which is two reasons. One, they get a pretty decent return for that. And two, it doesn't impact the cash flow of the development project, which is vital. And that's why our traditional investments have been so successful over the years, I think. Now, with this in mind and all these repeated questions about a monthly income, we have developed a new offering, which I think you're hearing it probably first in terms of a platform today. And we've also tried to accommodate those who want a slightly lower barrier to entry. The 100,000 Rand is prohibitive for some. And this investment, which I'll explain to you in quite simply, produces a monthly income, and it's from 50,000 Rand onwards that people may invest. Right. So to go into some detail, this is where investors can invest capital into the completed product in these projects. When I say completed product, built, finished with a tenant inside, fully maintained, rental insurance in place. So the objective is that tenants get investors get a monthly income without fail. They're also part owners of the asset, so they have protection by virtue of the asset. So they have security, direct security in the asset. And this is taken over a protracted period, anything from 1 to 5 years. So investors then get the benefits of the appreciation in value of the asset. So traditional buy-to-let, for example, you've got to get a bond. You deal with the banks. In that case, you deal with tenants, you deal with maintenance, and there are a lot of ancillary issues that one has to contemplate. This is a capital investment. You get a monthly return, you get upside on the investment, but you don't deal with all the hassle. And I think that's fundamental to it. So we look forward to seeing how investors' appetites look at this. Now, I think we'll give you an indication as to some of the returns. I think if you can bring up some sort of visual, Neil.
Yeah, there we go.
Yep. So we've tried to tackle some really vital issues with this new investment offering. The first one, most important, is always security. So we've tackled that. So the capital is secured by the asset. 2, investors are getting a monthly income, which is what I've mentioned before. And 3, there's growth on the investment. So it's almost like the trifecta of investments in one. And the investments at the moment, the month-on-month returns average just under 7.3% per annum if you take it over the 5-year term. If you add capital growth in terms of that, then investors are looking at a return per annum over time, averaging around 12.6% per annum. And that's with a pretty conservative escalation that's been built into that. So we're quite excited to see how people take to this new investment offering.
Excellent. Well, that's great news there, Nick. I think definitely something which I think is make investors look up over there. I'm going to ask, we got a short little video over here, from some investor interviews. So if we can maybe just run that, and then we'll start dealing with questions from the audience. Once again, I say to the audience, please submit your questions. I see they're starting to roll in, and we'll deal with that a little bit later. So we can just bring up the video, and thereafter, let's deal with the questions.
What made you gravitate towards us?
It's a good question. I think the key thing for me, when we met, you'd already been in business a few years and you had a track record. You'd already delivered several successful projects with consistently high returns. And that gave me a lot of confidence. And, when you look at the projects that you had exited, the returns were there, the proof was there. So it made it, quite risk-free. You had done what you said you could do. Right. You had evidence of it. And obviously you gained the experience and the track record. So that gave me a lot of confidence.
So I've always been looking for other ways to do better with my money and make it work better. And that's when I was introduced to you and your company. And after we sat down, to me, it's a no-brainer. It's an absolute no-brainer to invest in something that is more tangible. When I'm invested in one of your developments, I can physically get in my car, because I'm in Cape Town, and I can drive to it. I can see it.
If I can just summarize, you're looking for good returns that are above average, but you're also looking for security and safety within your investments.
I think that the balance of risk and reward that opportunity offer is unsurpassed. I think that you are, the investor is actually on the good side of that balance, whereas in alternative investments, I think the investor is on the wrong side of that scale.
Personally, investing is not something I know. And I think you invest with people that you do know.
Right.
And that you trust.
Right.
And I trust you guys, so it's been an easy ride for me, because the trust is there. The numbers and the way you do it still confuses me, to be honest, but it doesn't matter because I trust the way you guys operate. And 6 years later, you haven't let me down, so wow.
Wow. Okay, so these quite a few superlatives there, like no-brainer. We trust you, risk and reward. No, but on a serious note, I think that tells a lot, because I think people, we've heard so many times, so many people put their money down in investments and disappeared. I think you've discussed it in such a way that that people can really sort of understand it. So I'm gonna go into a question which is related from the audience. So please, audience, send your questions. I see they're starting to flow in, and it's probably related to what the one gentleman said, that he trusts you, and the other risk and reward sort of leans over on the investment side of things. So before we get there, and I'll ask that question from the audience, I just want to ask a question, and I don't know who wants to take it, Wynand or Nick. We've seen in a market where we are right now, where the economy is in a downturn and there's high inflation and that kind of stuff, people are looking for a safe haven here. And we heard from a few of the people there that, I don't understand investing, I don't do that. And I mean, are you starting to see more of a shift of people coming into this sort of alternative investment with a fixed income, but almost knowing exactly, if I put my money down, I know exactly what I'm going to get in return? Are you seeing a shift in a trend there? Who wants to take that, Nick or Wynand?
Yeah, I'll happily take it. Thanks, Neil. Look, I think the consistency in, we can only comment on our investments per se, and the consistency over the years, I think, has definitely appealed to investors. I mean, our increase in investors in terms of those who've invested with us before and continue investing is probably our biggest new investment rung, because people understand the offering better and they come along over time. But to answer your question, I think that consistency is really, really important, because the last few years there's been so much fluctuation in the market in general, and we're talking about the equity markets, property markets, interest rates, etc. That quite rightly, many investors out there are a little bit windswept. They don't quite know where to turn, and I think we've just plodded along quite nicely, giving similar returns year after year with protection. And I think that is starting to result in more and more people coming our way.
Excellent. Great. Nicely put. So I don't know if this question came from one of your competitors, but certainly people would look at this. But if we look at, because I think people are saying, okay, this leans over to sort of more the investor side. And one of the questions I got there, and it comes from an anonymous attendee, says, how does Wynand and Nick make their money? I mean, is it interest on the investment, or is it commission, or does the company invest themselves? I think a key question.
Yes, that is a good question. So to get straight to the answer is, when we look at a project, I mean, if I just take the fundamentals there, when you look at a project, you do your feasibility, and if you were to go at institutional finance, you'll allow for whatever the institutional finance offers. So with regards to our feasibility, we'll have a different figure in there. So if the institutional finance is 10 or whatever, 11%, that they're going to cost the company, plus their raising fees, which can probably be another %, that's the expense. So obviously, when we look at a project, our feasibility will obviously have a different expense because we're paying higher yields. So from a simple fundamental approach, we cannot entertain all the projects. We entertain projects that can financially afford the interest that we're paying our investors. So hence, when we take on a project, we allow for that in the project's feasibilities. So that's one of the main fundamentals for how we approach these projects. So we look at various projects before we actually go ahead and take on a project. And then there's obviously what affects that is timelines. You know, if you have to take a project from scratch to the end, or if a project's ready to go, et cetera, et cetera. So all of those are the factors that play a role in determining whether we get involved. So our financial feasibility is done different, if that answers the question.
Yeah, no, absolutely. So I think let's start dealing with some of the other questions that have come up over here. One came from Wynand, and she says, does the 16.75 per annum return include time value of money? So how is this return calculated? Who wants to have a crack at that?
Yeah, I'll do that. Okay, so to answer that question, one, that 16.75 is a running return. So every couple of quarters, we look back at the previous 5 years, and we take the average investment or the average return to investors across time. Now, our investors are on a tiered investment. The lower the investors who come in from 100,000 at the moment, for example, to 499 are at 14% per annum, and that tier goes up depending on how much one invests. So that has an influence on that average investment. Now, you're talking about, the actual question was the time value of money. So usually one would only take time value of money into account after 12 months, because an IRR, for example, is a pointless calculation if it's for less than 12 months. We
What's
use
an IRR? Nick, come on, give us an IRR.
Sorry,
don't use all these DLAs. Your 3-letter acronyms.
a lot of I think a lot of investments in this kind of space, when they project investment returns, they use internal rate of return, which takes into account the time value of money. It is not. We use per annum returns because it's a lot easier for people to understand. That is the return that you're going to get. Now, to answer the question directly, our average investment cycle over nearly 9 years is about 16 months. So with our per annum rates that are offered, we don't take time value of money into account. It's a per annum rate that is calculated on the capital invested.
Excellent. I think nicely put over there. Next question is, can you talk us through development yields in the current market, in the current economic environment? So maybe you can talk us through your development yields. Maybe we could also look at what are other average development yields, because I think in the current sector, a lot of developers are probably not achieving that kind of numbers currently, I think, certainly. So maybe do you want to just take us, who's going to have Wynand or Nick? I'm going to say eeny, meeny, miny, mo.
When you refer to development yield, is the question directly as to what is the return as a percentage the development makes? I just want to understand exactly what the question is with regards to that.
It's a little bit vague. I think.
Yeah, that's why I said I'm not sure exactly.
Yeah. Look, it's just, can you talk us through your development yields in the current economic environment? It's not very specific, but maybe you could talk from a broad perspective in terms of, maybe make some assumptions in this.
Yeah. I'm gonna. Okay, so if we look at the development yields, typically in the development industry, if you go into the formal finance sector, you'll be looking at anything from 15 to 20% to get financing on a project. So that's sort of the going rate in the market. So we operate in that same environment, and obviously a bit higher depending on the project. So I'm getting back, I can only talk for our projects. I'm not going to be able to talk for the rest of the market's projects. So when we look at a project, we obviously look at how quickly we can get in and we can get out, which is probably what most developers do. So from a yield point of view, we look at those sort of numbers, 20% plus. As I mentioned earlier, we don't go to projects lower, and hence we only do specific projects that we feel can give us a proper yield, hence tying up with our investors returns.
Excellent. Nick, I'm going to, because I think this is a question for you. I think, you've specifically chosen, and, I think a location is so important, especially in the current environment, because there are trends. And if we start looking at sort of property stats and numbers and what have you, and, in South Africa, we see, and I'm not talking over sort of a year period or 2 year period, we look over probably about 10 years, and we look at sort of by province. If we start looking at Gauteng, we start looking at Free State, we start looking at Western Cape, Northwest, KZN, and we start looking around the country in terms of what is sort of property growth? What is the capital growth numbers being like? And it's clear that there's a winner. And without me actually intimating who it is, I think this is certainly.
Neil, I wish I'd heard that question before the webinar, because strangely enough, I was actually looking at some stats last week or the week before, and some statistical analysts have come up with a graph showing from 2010 to 2022, the growth in the main metropoles of each province. And it's quite a stark image, because all the other metropoles are either flatlining in terms of year-on-year growth from 2010 to 2022, but the Cape Town metropole has got a much higher yield on the curve, and the growth is just stands out like a sore thumb. And if I'd known about the question, I could have shared it on the webinar. I could have shared the actual image. But Cape Town metropole and the Western Cape has outperformed the rest of the country by quite a large margin.
Yeah. So
Neil, straight back at you. I have a question for you, and I know that's not the usual format of a webinar, but I think
putting me in a position now.
yeah. Well, the thing is, we want the objective of this is also to just discuss investments in general and get some insight, and we get insight along the way as well. But you've just asked about the rising property values, and I've just answered about the fact that the Cape has been a lot higher. So my question to you, and I ask you the question because you speak to a lot of investors, you speak to a lot of property guys, etc. do you think the rising values in Cape Town, the rising property values, are a good hedge against inflation in this country? Because inflation's quite high, but I think the property prices in the Cape are rising higher. So probably a good place to buy.
No, absolutely. So, I mean, just to answer the question quickly there, Nick, I mean, if we start looking at sort of international type investments, and I'm talking about very similar type investments offshore, it is very difficult, and it is really very difficult to achieve double-digit returns offshore and in different currencies, the likes in sterling. And it's just is, and it probably is a fact that South Africa still is a massive hidden opportunity. And if we start sort of unpacking the Western Cape, it is a little bit better run than the rest. And that's why I actually asked the question, and it shows obviously in the immigration numbers, and that's driving a lot of sales here in the Western Cape, and it is a massive trend. But I think if we start looking at, you know, the sort of real estate returns, I mean, if we look at it just per se, we start seeing South African numbers probably haven't performed as well. But if you take just the Western Cape out of that picture, it is quite significantly higher, and it's actually on par with capital growth anywhere all around the world. So yeah, so that's my sort of comments and thoughts. And it is indexed for inflation. Real estate is always indexed. In other words, when there's inflation, as we're experiencing right now, we're probably going to have an interest rate hike, probably just after this webinar is done, I think at 2:30 this afternoon. We're not sure whether it's going to be 0.25 or it's going to be 0.5%. But, you know, these are the things that affect sort of investment. Sorry, Nick, you wanted to add to that?
Yeah, just you mentioned a word that stood out from what you're saying now is the word infrastructure. So, I mean, I feel it's my opinion is that investment is really difficult to come by, solid investment, if the environment that you're investing in has got poor infrastructure, because that's the foundation of everything. And just to go back in time, you know, Wynand and I, about 9 years ago, that's when we changed our strategy to focus on investment projects in the greater Cape Town region, because we'd been busy in other parts of the country, and we saw firsthand what was happening in municipalities there. And a light bulb went off for us to say, listen, this is not going well. The infrastructure is starting to crumble. How can people actually invest in these areas? So that's actually what was galvanized us to focus on the Cape. So I agree with you. I think infrastructure is a driver for investment without doubt.
Excellent. Great. So we've still got 2 other questions that we want to deal with here. Once again, audience, if you've got some more questions, I still see you hanging around. So that means that you do want to, you know, engage. So on the investment into the completed product with OPC, can you talk us through the ownership? Who actually owns the tenanted building? And I think you did touch on that a little bit, but maybe just, you know, let's just put some more emphasis on it. I don't know who. Wynand, do you want to have a go at this one?
I'll do.
Well, Nick is more, yeah.
Okay.
Nick,
go. So,
right.
So we were fortunate enough to work very closely with Worksman's attorneys on this particular offering. They put together a very detailed partnership agreement. So it's in the form of a limited partnership, and investors are limited partners, and it's linked to a particular unit. And that's the great thing, is you're not pooled amongst a swathe of other investments. The investors are a limited partner linked to a particular unit, and that gets registered, that limited partnership. The unit gets registered in the name of that limited partnership at the deeds office, of which the investors are represented.
Excellent. Okay, that's nicely put over there. And then there's a question on the yield on tenanted buildings, and it says 7.27. And I think that was actually on the slide that went up a little bit earlier on the bottom of the slide. Yield on the tenanted building says 7.27. Why should one put his or her investment in this asset when you could earn 11.23% in a risk-free government bond?
It depends. I think government bonds. Sorry, Wynand, do you want me to jump in there, or you?
No, go.
Yeah. So government bonds last I saw was about 10.8, 10.9, but they might have climbed in the last few weeks. So government bonds, in South African government bonds, are they risk-free? Okay, someone must answer that question. But the most important thing is bond yields are going to obviously change according to the interest rates, I would guess, plus some other factors that are involved. Why would people invest? 7.27 is the cash on cash investment, but that investment yield grows dramatically over time with the growth of the assets. So really what you're investing in here is time. The month-to-month income yield is not wildly competitive, because with interest rates rising as quickly as they have, you can get similar yields or slightly less in a money market. The advantage of these is these are units in great areas in Cape Town where the yields are based upon the yields over 5 years in terms of the growth are based upon a 6% year-on-year growth, whereas the average over the last 10 or 12 years in Cape Town has been more than double that. So very conservatively, we're looking at these yields over time of about 12.5, 12.6%, but they could be higher.
Okay, all right. Excellent. Okay, good. All right, so what I'm going to suggest we do, we're coming close to the end of the webinar. So I want you guys just to give your sort of final wrap and thoughts. And we've got a bit of time here still. So, for Wynand, you can probably give us maybe your 3 or 4 minutes, your final thoughts, maybe just giving a message out there to the investors, sort of going forward. I mean, there's a compelling argument here, and it's very difficult to say, well, what you're offering in terms of, I mean, unstoppable growth. The economy is not good at the moment, but you guys are offering something that outperforms it and is way above average what a lot of people are getting. So maybe just your final thoughts, give us give us some thoughts on how you managed to put this thing together and the sweat that went into it.
Yeah, no, Neil, let me do that, yeah. But firstly, thank you for having us on this webinar. Yeah, and to close off this, the structure that we've worked on started actually in the worst time of property that I think we've seen in a long time, and it was about in the 2008, 2010 crash, because you only really learn something when you go through it firsthand, and that's where this whole idea sort of came to fruition, and we sort of got clarity on how to go forward. It's because we saw a lot of people lose a lot of money just overnight, and we were involved in property at that stage, and so we went through those difficult times, and hence that's why we created this. And the main reason behind this is, as I've touched on earlier, is things will go well and things will go bad. That's just the fact of life. It always happens. So, and when they go well, we sort of tend to forget that it's going to go bad at some point. It's just, as I said, life. So what we've been working on here for the last couple of years is to try and put in place that when that happens, that you don't find yourself back to zero, that you find yourself in a position where you can say, look, this is what happened, this is what the world is, but if we see it through, we'll still have what we've put in, and if we hang on to it, we might have more. As you know, during those days, things would just wipe off the sheet. There was just zeros. So, and hence this is, as you said, this has been hard work, a lot of sacrifice, and what we've seen is specifically in the last 3 years, it's been the support and the investors have increased dramatically. And as Nick mentioned, mainly also because of the people that were involved from the beginning. They've just kept on rolling it, and they're comfortable with it. So we're excited. We can see a trajectory which is taking an exponential shape. So we're very excited about it. And yeah, we're looking forward to offer our investors good yields and security. That's just the name of our game. And again, thank you.
No, excellent. Thank you, Wynand. just listening to you, and we're going to give Nick, he's going to get the chance to wrap up as well and give his sort of 5 minutes. Guys, there's a book here somewhere. We're actually starting our webinars with our property authors, going forward. So we are going to be running. So I'm just letting the audience know about that going forward. All the property authors you're going to be meeting, and we're going to be running a series as part of that. So it's always interesting, when there's either, and it's all about the ups and the downs over there. But I think kudos. There's a lot of trust in you. You can see from those videos that we saw from your investors. There's belief in you and the product that you've created, which, I heard the word no-brainer a few times. And so in terms of the investment. So Nick, over to you, your final thoughts and your final wrap. And you've got a bit of time here to give us your final thoughts.
Neil, just you mentioned the word trust, but I'd just like to jump in there. So it's actually not us that the investors need to trust, because the structure that's in place is there to protect investors whether we are there or not. They're protected by the assets. The development company does not get access to the capital at any stage unless it's been authorized by the financial trustees of the trust. And these are independent trustees, authorizers. So they've got no vested interest in any of the developments themselves. So the structure and utilizing the attorneys as well. So the structure that's in place is a really consummate structure to protect investors and their capital. And it's not really about trusting us as individuals, because we actually don't handle the investor capital firsthand from that point of view. So that's the first thing I want to say. Second thing I want to say, and I say this quite a lot, is when investors invest, yes, they like to chase decent yields. Everyone likes to chase decent yields. Our yields are pretty decent, but the important premise of our structure is the fact that investors get all the security. And I cannot emphasize that enough, because the minute someone is involved alongside investors, sort of an institution or something, the investors, as Wynand said earlier, are going to rank second. And if things go badly, they will lose their shirt. So we are very adamant about the fact that while this has been a long process over very many years, building this and making it work properly, we've got fundamentally, the foundation is there to protect investors and investors alone.
Excellent. Well, that's definitely a nice premise to have for the investors out there. And thank you very much, Wynand and Nick. I think you've actually enlightened a lot of investors out there to take this opportunity. And for those that want to reach out, I encourage you. So it's almost the end of the webinar. And so thank you once again, Nick, Wynand, thank you. Thank you for your valuable contribution. It really has been insightful. I know we've done a few of these, but I think today in particular, I think we managed to unpack a lot more. And it's interesting, even with your new offering that you've got as well, there's always something new that comes on the horizon, from 50,000 Rand upwards. So what an opportunity. So I encourage you all, our audience, to reach out and engage with both Nick and Wynand. And I know those have indicated on the polls that have requested a consultation, and their team will make contact with you, or you can email a request to info@rei.co.za. And to you, our audience, thank you for joining us today and your participation. We hope that you got exceptional value from today, and I hope that everyone's eyes open to new investment opportunities, and that you will investigate it, and more importantly, grab that opportunity that is presented to you today. Because as they say, you should invest probably 20 years ago, and if not 20 years ago, it should be today. So that's the second option. So my suggestion is Warren Buffett said the most, and he's already said a lot, and I'm not going to say one of his standard quotes over here. And he said the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. So yeah, so that moves on to, so thank you again to Nick and Wynand. It's our next event. It's our next webinar as Thursday. So that will be on the 1st of June from 11:30. We've got a bit longer titled How to Build a Globally Diversified Passive Income with Property author Scott Picken. That's next Thursday. The week after, we're going to be back to Wednesdays because we've actually got, we're going to try Wednesdays out for webinar. That'll be on the 7th, where we start with our property author series. And so we're going to be talking to people in the industry. But so to register, you just go to the REI website. We could just drop a link below to the upcoming events box. And if anybody wants to get a recording, the recording's available. We will send the link through to you. Please reach out to Nick and Wynand. And thank you once again, guys. And thank you for the audience for joining us. Stay safe and successful investing. And until next Thursday, this is Neil Peterson of Real Estate Investor signing out. Cheers, everybody.
Thanks, Neil.
Thanks, Neil.